As many of you know, Balmain is what it is today by virtue of one thing. We've been placing our borrower clients' commercial real estate loans with lenders for over 40 years, just before I was born. In fact, this year we placed over $5 billion worth of real estate debt with lenders, obviously including Balmain, and we've placed an average of $4 billion worth of real estate debt annually for over 20 years. It is this brokerage business, our origination engine, which is the key differentiator to all other private credit lenders in Australia. We own our own loan origination network. We do not rely upon third-party brokers for deals. We have 100 staff dealing directly with borrowers, meeting them, forming a view on them, not always positive, inspecting the properties and forming a view on them, again, not always positive. We get into the weeds and understand our loans firsthand, not from hearsay. This is our origination engine, and it works. So whilst just a broker for over 20 years, it was an obvious progression for Balmain to establish a lending business. There are two principal methods of funding a lending business. You can borrow money from investors like yourselves, or you can borrow money from a bank. Given our pedigree, in fact given our name, Balmain NB or Balmain Non-Bank, we chose to raise money from investors. We are the sole business that sits between our investors and our borrowers. That's why I'm here today. That's why I send you monthly newsletters. That's why we encourage your personal interaction with us, whether complimentary or critical. We do not raise funds from wealth advisors, planners or other intermediaries. We deal with our investors face to face, one-on-one. In short, we can pick up the phone and talk to every investor we have. That's the way we like it. And we hope that you like the fact that whenever you feel the need, you can pick up the phone and talk directly to the horse's mouth. Or if you get put through to me, the other end of that lovely beast. But now let me turn to the Australian economy and matters domestic and how that might impact on BOT's performance. As I mentioned at length last year, discretionary goods have been experiencing price deflation for over 18 months. Price growth for non-discretionary items such as fuel, insurance, health and education, which drove inflation to its recent peaks, is also now abating. As at April, the annual inflation figure was down to 2.4%, the same as it was in March. Even the RBA's more conservative trimmed mean inflation measure is back down to 2.9% on an annualised basis. That's down from a peak of 6.8% 2 years ago and 4% last year. More importantly, this level of inflation is trending to within the RBA's long-term target range, and this sets the climate for further cash rate cuts. Unemployment is also trending slightly higher, bringing further weight to the argument that the Australian economy is weakening and requiring some level of monetary stimulus. We know from our own businesses that whilst consumer confidence is improving with the last two rate cuts, business confidence is still struggling, especially in the light of recent events in the US. 2 weeks ago, the RBA cut the cash rate by another 0.25%, down to 3.85. And notwithstanding plenty of waffle in their statement about global uncertainty, we should still see another 3 to 4 rate cuts, totalling a further 1% over another 12 months, as the economy heads towards a period of low GDP growth or possibly recession. These events would, in aggregate, provide relief to the mortgage bill and would imply that housing prices should enjoy favourable tailwinds. So to sum up, whilst there will be pressure for lending rates to fall over the coming 12 months as the RBA dials back the cash rate, BOT distributions will be much slower to reduce, given the fixed rate nature of our loans, an uptick in high yielding construction loans, and a small benefit of a cheaper settlement facility. We have a healthy book with easily manageable arrears, and we maintain no exposure to the commercial office sector. Net overseas migration remains at over 500,000 people per annum. This is significantly above any prior period in Australia's history. And yet housing starts remain at all-time lows, 20% off the 20-year average. To put this in perspective, housing starts are running at 40,000 per annum, compared to assessed current annual housing demand of 100,000 dwellings per annum. We're talking fewer housing starts today than occurred when Australia's population was 30% smaller than it is today. Notwithstanding, our population is growing 30% faster than it was back then. But why are housing starts so low? It's reasonably simple. Development remains completely unprofitable. The prices of building materials and labour can't reduce. Sale prices have not risen enough, and land values have not corrected sufficiently. In bygone days, today's market would trigger a drop in wholesale land values, which would make development feasible again, so supply could be replenished, kick-started. But this is not happening. This is down to one major factor. As a hangover of the GFC and the resulting conservative lending practices that followed, the level of debt or gearing used by developers to hold their valuable development land is significantly lower than it's ever been in previous cycles. So lenders are not forcing developers to sell their development sites because they've breached their loan covenants, and nor are the developers themselves forced to sell their valuable land holdings to generate cash flow to keep their business alive. The developers can afford to hold and wait for selling prices to increase, and that is what they are doing. Absent the normal downward correction in land value, we're left in a position of massive and ongoing undersupply. The demand from our ever-growing population, however, is unabated. Whilst there is no doubt that high interest rates and a preference to see them start to fall before making buy decisions has kept this demand under some control, there is simply inadequate supply to satisfy even this restrained demand. This is clearly evidenced by ongoing housing price growth across Australia. With lower interest rates arriving, true demand will again be released, and further price growth is inevitable. Whilst it is true that this price growth will itself spur developers into action, the lag in delivering housing stock is measured in years, not months. There's no quick fix to the undersupply. There's no quick way to build. I had a chuckle reading the Victorian budget last month and the additional relief being offered to some home buyers. Heavens, please understand, you need to stimulate supply, not demand.